The next question is asking us whether we should make or buy, so it's another outsourcing question. It says that the company has always made its components in-house. However, another company has recently offered to supply the component at a price of $12. We need 4,000 of these components every year. To produce in-house, the cost per unit appears to be $14.55. It says that the fixed overhead cost is an allocated expense. None of it would be eliminated if the production stopped. So if it cannot be eliminated, that means it's going to be there regardless. It's unavoidable, so it's not relevant. So we are going to ignore the fixed overhead. So if we look at the relevant cost to make, again, what you're looking at is the direct materials plus the direct labor plus the variable overhead plus any avoidable fixed cost. But in this situation, we do not have any avoidable fixed cost, so we are going to leave it out. So your cost per unit is going to be $11.55 per unit. You need 4,000. So that gives you a total relevant cost of $46,200. To buy the component, it says that we would have to purchase the component at $12 a piece. We're going to have to purchase 4,000 units. So that's giving you $48,000 of relevant cost. So the difference is the difference between $46,200 and $48,000. So that's giving you an $1,800 difference. So to decide if it's increase or decrease for the correct answer, you just have to read the question really carefully. It says, by how much will operating income increase or decrease if we decide to purchase? Okay, so let's say right now we make, so we're saying if we purchase, what would happen? Well, if we purchase, we'll have to pay more, so that means income would go down. So your correct answer would be B, decrease. So again, to get the dollar amount difference may be very easy to you. To determine whether it's an increase or decrease, you just have to read the question really, really carefully. Question number 12 is a special order question. It says that the company's been approached by a new customer to purchase 2,500 at a price of $695. No existing sales would be affected. Right now, we're only planning to sell 9,000. We have capacity for 12, so we have plenty of extra capacity to take on the special order. Normal sales price is 11. Cost information is as follows. It says if we accept the special order, no fixed manufacturing cost will be affected. So that means fixed overhead is not going to change at all. So that means it's not relevant. So we're going to leave it out. So we're looking at the additional revenues minus the additional expenses. So your additional revenue is going to be $695 times the 2,500 units. And then subtract from that the additional expenses. So your additional expenses are going to be the direct material of $1.75 plus the direct labor of $280 plus the variable overhead of $140. So your variable overhead cost in total, it's relevant, is $5.95 times the 2,500. So basically, you're making $1, right? The sales revenue is $695. Relevant variable cost is $5.95, so it's $1 difference. So you would have profit of $2,500 if accepted. So your answer is A. Question number 13 is a segment elimination question, or keep or drop. We have two portable sound systems, A and B. If you look at this, it looks like B is not doing well, so we're trying to figure out if we should drop B. If the product is dropped, sales of System A headsets will not be affected. The fixed costs are non-avoidable. So what this is saying is that out of these total fixed costs, then they're going to stay the same, okay? So if B is eliminated, what's going to happen to our operating income? So if we eliminate System B, we want to figure out what all is going to go away. So if B is eliminated, we will eliminate, so basically we're writing down what will be eliminated. Well, the $32,500 of revenue will be eliminated. The variable cost of $25,500 will be eliminated. And that's it, because it tells you that fixed overhead is non-avoidable. So that means that if we eliminate System B, we can't eliminate that cost. So basically, that leaves you with $7,000 of profit. So if we eliminate B, we will actually lose $7,000 of income. So income would decrease by $7,000. So your answer on 13 is D. $14, same thing, is segment elimination. So we're trying to figure out if we eliminate. So we're just basically asking what will be eliminated. We are looking to eliminate product C. It tells you that the rent is a non-avoidable expense. So rent is going to stay the same. So the total rent is still going to be $355, whether we have A, B, and C, or whether we just have A and B. Now, it doesn't say anything about advertising, but it does about rent. So this is where you have to make the assumption that the rent is, that the advertising is avoidable. Plus, if you think about it, if we're not making or selling C anymore, we wouldn't have to advertise for it. So the $30,000 could be eliminated. All right, so let's talk about what else will be eliminated. Sales revenue would obviously be eliminated if we got rid of C. The variable expenses would be eliminated. And then rent, nope, it's going to stay there regardless because it tells you. Now the advertising could be eliminated. So that leaves you with $30,000 of income. So basically what that means is that if we eliminate C, we will eliminate $30,000 of income. So that means income would decrease by $30,000. So your answer on 14 is D. Question number 15 says that we plan to start producing and selling a new product. Market analysis shows that the product can be sold for $100 each. The company would like to have a profit margin of 25% on each unit sold. So the question is asking for the target cost. So basically, you just have the basic equation, sales minus cost equals profit. So we know that the sales price is $100 each. We don't know what the cost is. That's your target cost, your TC. What should the cost be? Because we know that we want our profit to be 25% of $100, right? Because margin, we know, is a percentage of the sales revenue from the previous problem. So we basically want to have a profit of $25 per unit sold. So in order to do that, your target cost has to be $75, right? So if the profit is 25 and the sales is 100, then that means you have to try to conform that product and sell it for, produce it for $75 a piece. 16, industry produces a light fixture with the cost, material, labor, variable overhead. Production capacity is 30,000 units. Currently, the company only expects to produce and sell 180,000 fixtures, so you have a lot of extra capacity. The company also has fixed selling costs totaling $500,000 a year, variable selling cost of $100 per unit. We normally sell our fixtures for $12 each. However, a customer from outside the region comes and wants to buy 100,000 fixtures from us, which is great because we have excess capacity. They want to pay $7 a piece. The order would not have any variable selling costs. Okay, so this $1 of selling cost, we're not going to incur that if we take the special order. The fixed overhead is unavoidable, meaning it's not going to change whether we accept or reject the special order. It doesn't matter. If we accept, how much will profit increase or decrease? So we're looking for additional revenue. So the special order is to receive $7 a piece for 100,000 units. So your additional revenue would be $700,000. And then subtract from that your additional expenses. So your additional expenses are going to be the materials plus the labor plus the variable overhead. Okay, so if we have to make 100,000 more units, we have to incur more material, more labor, and more variable overhead. Fixed tells you is unavoidable, so you ignore it. So it's the 2 plus the 1 plus the 3. So that's $6 a piece at 100,000. So you're basically going to be able to make or increase profit by $1 a unit. So that leaves you with $100,000 that your income will increase. And our last chapter 13 exercise says that the company currently manufactures a component of its product. The company is considering purchasing the component from a supplier for 10. We need 5,000 to produce. We have material, labor, variable, overhead, fixed overhead. It says the fixed overhead is the equipment maintenance, which is unavoidable. Okay, so it's unavoidable, not relevant. If the company decides to purchase the component instead of making it, what will happen to income? So basically we're looking at the difference in the relevant cost between making and buying. So we're looking at the relevant cost to make. Remember we said that our relevant cost to make is going to be direct materials plus direct labor plus variable overhead plus any avoidable fixed cost. We don't have any avoidable fixed cost. It tells you the entire amount is unavoidable. So to make, your relevant cost is $9 a piece. We have 5,000 units that we need. So that's going to give you cost of 45,000. To buy, the cost to purchase is $10 a piece. We'd obviously have to purchase 5,000. That's going to give you a cost of 50,000. So again, to see if it's an increase or decrease, you just have to read the question. If the company decides to purchase instead of make, okay, so right now we're making, right now our relevant cost is 45. If we decide to purchase it or buy it, then the relevant cost would be 50. So if you have to pay 5,000 more, or if the cost is $5,000 higher or more, that means income will decrease. So your answer on 17 is A.